Hello and welcome to another episode of Darwin Investors. Did anything interesting happen in the market this past week? I don't really know. I was at work, which according to Jerome Powell is the problem. I've got a great show for you guys today. So if you can make it to the end, there's some really interesting content there. Like sometimes I come across some good stuff and it just doesn't fit into the context of the show because believe it or not, I carefully construct these shows. So I throw in my fun material at the end where it doesn't really get in the way. So in today's episode, I'm going to be talking about the banking collapses. Oh, and Silicon Valley Bank has like 8,000 employees and Silvergate has like 1,000. That should get you well on the way there, Jerome. There's 9,000 more for you. And the startups, they won't be able to pay their people either. There's another head start for you, Jerome. Oh, inflation is going to go down now. So I'll be talking about the banking collapses. I'll be giving my inflation forecast for next week and how I feel that the inflation forecast and the banking collapses are going to have an effect on the FOMC meeting and their rate hikes and what direction that's going to drive the market in. And then finally, I'll be looking at my own portfolio where we're going to talk about the USOI dividend that they're going to pay out this month, and it's going to be a whopper. And then I'll show you how I'm positioned for what I believe is going to be the market direction in the coming weeks. So there's a lot to get into, so let's go ahead and get started. All right, so a couple of banks collapsed here this last week, in large part due to the lag effect of higher interest rates. And so a lot of banks, they're very dependent on customer deposits to stay afloat. Now, a lot of these customers are pulling deposits out of these banks and they're putting them into higher yield treasuries or into money market funds to try and get some positive return. But what that's doing, it's forcing a lot of banks to liquidate all or part of their bond portfolios in order to cover their losses. And so the movement of this money this past week did force a couple of banks to go under, as we all know, Silicon Valley and Silvergate. Now, a couple of weeks ago, I saw this interview on television with James Bullard, who, if you don't know, is maybe like the most hawkish member of the Fed. And he was actually a voting member of the FOMC up until like last December. And so he's like in favor of like pushing rates up to like 7%. I mean, he's that hawkish. And he's so out of touch with reality on this interview that I decided I'd record it because I thought I might be able to use it to possibly illustrate how shockingly clueless the Fed is with respect to the lag effect of their own interest rate hikes. And I thought I'd be able to use this video in a few months. I didn't think it'd only be like 2 weeks. So let's go ahead and have a look at this video because it really is shockingly dumb.
The economy has not yet, given the long and variable legs of monetary policy, the economy has not yet felt the brunt of the rate hikes that you've had. So why wouldn't
What about housing?
So you
housing
think
is the most interest-sensitive sector.
Look, I'm not arguing here. I'm just asking you. Do you feel like okay, so you hit like 2.5 in August, and since then there's been a restrictive policy. Is it in the economy now, or is it yet to come? And if it's yet to come, doesn't that argue for being more cautious?
I think this is the age of forward guidance, and so the long and variable lags argument doesn't make as much sense as it made decades ago, and Milton Friedman made it. So you're saying ahead of time, here's what we're going to do. Get ready. We're going to adjust. And I think, frankly, I think financial markets did a pretty good job of adjusting, and we didn't get financial crisis or anything like that because we were credible and people saw, okay, we're going to have to move to take care of this inflation problem, and they adjusted appropriately.
Jim, you're also reducing the balance sheet at quite a decent clip, $95 billion a month. You've got these rate hikes either in the economy or in train to hit the economy. Some reports this morning about some foreclosures, some bankruptcies in the commercial real estate market. Are you worried that something could potentially break in the financial system that would cause you or force you to reverse policy?
Yeah, well, we do watch this very carefully, and we are sensitive to this. But if you look at the St. Louis Fed's financial stress index, which is designed to detect this kind of thing, it's still at a very low level. So right now, I don't think we have financial stress, but we'll always keep an eye on it.
You might want to keep a closer eye on it, Jim. So I believe by now we're all familiar with the Silicon Valley Bank and the Silvergate Capital Bank collapses this past week, and it's been done to death, and there's lots of resources on that. So I'm not going to go into too much detail on either one in particular, but I do believe that a lot of people might be looking past these collapses to some degree because both of them are kind of in unique situations. One's a crypto lender and or like a crypto bank, and the other is like a leading lender to tech startups. And we all know how those investments have fared the last couple of years. So obviously they had to dig into their other reserves, that being 30-year treasury bonds. Now, both of these banks did use 30-year treasury bonds as a way to barbell the riskier aspects of their portfolios. But the fear now is that because it's the treasuries that are failing, that it could have a contagion effect into some of the more conservative lending, smaller regional banks who are going to have to liquidate parts of their portfolios as their customers break out deposits, remove their deposits and move them into higher yielding treasuries or into money market funds and the like. Or at the very least, they're going to have to start paying dividends. And these dividends are going to compress the margins of these smaller regional banks. And for that reason, those bank stocks, those smaller regional bank stocks are collapsing. It's not because Wall Street believes that all these banks are going to go out of business. So I want to get that out there right now. This is not this is not panic mode that all the banks are going down. What this is Wall Street sniffing out the fact that these banks are going to have to pay out higher interest rates, and their margins are going to compress. Because their margins are getting compressed, then their stock prices are going down. And these aren't big margin companies to begin with. They run a very small margin. And so this is going to make it even smaller and probably in a lot of cases negative. And Wall Street is just pricing that in right now. So let's go ahead and have a look at this chart to show the unrealized losses on bank portfolios right now. So what we're looking at here is the banking industry unrealized gains and losses chart. The yellowish line here would be the available for sale securities. This would be your stocks that they might hold, but more likely it's going to be the bonds that haven't yet matured. And the bluish line here is the held to maturity securities, and this would be their bond portfolio that has matured. Now here recently you can see that that we're in excess of like $600 billion in unrealized losses in the banking industry. And as that's far and away the largest, at least since 2008. I'm guessing if you stretch this chart out forever, it's the biggest ever by a long stretch. A lot of these are held to maturity securities. This line is getting shorter, but as interest rates really aren't going down, they're kind of staying steady. I wouldn't expect that this line would have gotten shorter unless these banks are now realizing some of these losses. And that's not to say that I'm expecting that there's going to be like, a banking collapse or anything like that, because I definitely don't think there's going to be a collapse, but there are some obvious cracks that are forming right now in the banking system. And in my opinion, the Fed should stop their interest rate hikes altogether. I do think they're going to do 25 at their next meeting, but it's my belief that they should just stop it altogether and definitely stop with all this hawkish rhetoric until things settle down a bit. I mean, Powell just got out there in front of Congress and says the solution to our problem is to raise interest rates and put everyone out of work. That is the dumbest combination of financial or economic advice that I think I've ever heard in my life. But that's what he's advocating. And because that it doesn't seem like logical that the Fed would raise interest rates, that's exactly what the market is pricing in right here. So here is a chart of the 2-year treasury. We can see that when Powell started talking, at least beforehand, it would have been about 4.87. And as he got to talking, it spiked way up to over 5 while he was talking to Congress. And again, that has to be with the fact that he was advocating for higher interest rates and putting 2 million people out of work. And I'm not saying that that's the dumbest combination that you could possibly come up with, but if you can think of a dumber one, stick it down in the comment section. I'm just saying that you'd be hard pressed to come up with a dumber combination than that. It wouldn't be easy. And then so after the bank collapsed, we got down to 4.57%. The same thing happened over here on the 10-year treasury. If we look at it here, it also spiked while Jerome Powell was talking. And then after the banks collapsed here, it went down to what is that, 3.68%. If we look at over the course of a month, it's actually lower now than it was 1 month ago. And this is being reflected in the future federal funds outlook here. We can see that at one time here in January 24, it looked like it was going to be 5.5 with a high of 5.63%. Now, when we look at the Fed rate outlook for 2023 in the year-end forecast, we can see it's come way down. It's now 4.99 in January 24 and 5.26 in October 23, indicating that now we're pricing in a 25-point rate hike here at the next FOMC meeting and not a 50. As a matter of fact, in this Fed rate outlook, it looks like they might even be pricing in a 25-point rate cut by the end of the year, which I don't necessarily see. But if there's enough fractures in the banking industry, I imagine that they might actually have to consider doing something like that. So let's go ahead and have a look at the inflation forecast that's going to be coming next week. Now, when we look here at Trading Economics, it gives the inflation forecast for the upcoming month, and the consensus is that it's going to be 6%, and the forecast is for 6.1%. Now, I, for one, think it's going to be well below 6% when the inflation data comes out here on March 14th, which is going to be, next Tuesday or so. And so to get us to 6%, let's go ahead and look to see how much it would have to be month over month to get us there. We can see that last month it was 0.5 and before that it was 0.1. So the 0.5 would be on the high end, 0 would be on the low end. I do believe that February is going to be much lower than January. There's this thought out there that the inflation needs to decline in a linear fashion, and then they're not expecting choppiness at all. I think that that's unreasonable. And so last month we had this blip, and we're having to relive this blip over and over. We had to relive it right in front of Congress. It was just like it wouldn't get, this bad month wouldn't get out of the way. But what I know is that the month of February, energy prices came way down. This natural gas came way down. This was really, really high. If you look at it over the course of your 6.7 is wicked high. And so this one here might actually be negative month over month. That's what I'd expect. At some point, used cars are actually going to stop being negative. They're going to start going up in price at some point. This one might come up. But for now, I don't really know. But all I know is this, is that things seem cheaper in February than they did in January, especially as shipping prices came down. The whole commodity complex crashed here in February. Lumber, lithium, and the like, everything, mining and minerals, things were just down in February relative to January. And for that reason, I think that we're gonna be way lower than this number right here. So let's go ahead and see how we get this number. Now, for you, past viewers, try and bear with me. I'm just going to quickly go through this for the new viewers, how we come up with a year-on-year inflation rate by the numbers. So you get this here from the economic data at the Federal Reserve of St. Louis. And all you do is you take this number here, this 300.536, and you divide it by 1 year ago, and that's 282.599. And that will get you to that 6.4% that we're getting year over year, or in this case, 6.35, which rounds up to 6.4. Now, the consensus is that we're going to be at 6% year over year. So to get that, you take this number here, which is going to be our February data, which is 284.61, and you multiply that by 1.06, and that gets you to 301.68. Now you divide that by our January data, and you divide that by 300.536, and that would show that month over month, we're expecting a 0.4. 0.4 is, remember, it would be kind of on the high end. I think for me, the high end would be 0.2 and the low end would be 0. Let's go ahead and figure out my high end of 0.2. And if we do that, we're going to see that our number comes out considerably below 6.0. So I'm actually below the consensus here. So the way to get this number here is you take this number here, 300.536, and you multiply it by 1.002, and that gets you 301, and you divide that by this number, and this is where I think that will be on the high end. You divide that by 284.61, And that gets us to 5.8% year over year. Now, I actually think it's going to be zero. That brings us down to 5.6. But, on the high end, I think it's going to be 5.8. That does a couple things. It gets us below the threshold of 6.0%, which is going to be a psychological threshold that inflation is actually coming down. And so then I think that's going to send the markets up. You got banks collapsing. So I don't believe that at the next FOMC meeting, they're going to be raising rates as high as a result of this number. And that's going to send the markets up. And the next thing that's going to send the markets up is that we're going to be in the Fed blackout period. We actually started the period today. It doesn't end until the 23rd. That means that these guys can't turn around and say, hey, we have 5.8%. That's still almost 6. Inflation's really high. It's out of control. Your job is a problem. We need to fire you and we need to hike up interest rates because inflation's wild and out of control. They're not going to be able to say all of that until after their meeting here on the 21st and 22nd, when I expect that they're going to give a 25 basis point rate hike and not the 50. And for these reasons, I believe that the market's actually going to run quite well here for the next week and a half or so. And so this is the way I have my portfolio position. So this past week wasn't the worst, wasn't the best, whatever. It was kind of like medium. I actually had an okay day yesterday, as strange as it seems. USOI was up $578, and probably because of the dividend that they're about to pay out. Overall in this position, I'm down $1,900. I did get a $2,150 dividend earlier in the week, so I'm up to a couple $100 on the position. Not so bad. I had a bunch of covered calls here that were open. There's 4 covered calls here. You can see that I'm up pretty good on a couple of these positions. Obviously, as stuff goes down, your covered call positions become a better value. What this says is that by the 17th of March, if ConocoPhillips is below $115, I get to keep your money and my stock. If it goes above $115, let's say it's $118 by next Friday, I have to sell you each share at $115, even if it's $118. And someone's paid me $71 to make this contract. Right now, ConocoPhillips is about $104, so this contract's worth more to me than it is to them. It's currently worth $62. And you can see that I have a covered call open against Chevron, one open against Phillips 66, and one open up against Marathon Petroleum. You can see I'm very heavily invested in oil. And it's not because I'm like this huge oil bug. What I am is I like stocks right now that are kind of like bond proxies. I don't have enough money to actually make a 5% yield on a bond worthwhile. So what I do is I buy stocks that are kind of like bonds in that they generate a dividend similar to the rate of return on a bond. However, they are stocks, they can go down, they are a bit more risky. But if you pull, let's say here, ConocoPhillips, and you see that ConocoPhillips is trading with a dividend yield of roughly, say, 5%, which is actually better than the 2-year yield right now. But if you give this yield right here and ConocoPhillips should go up, let's say 7%, you do the math. I'm now up 12% rather than the 5% on a bond. USOI just announced that their dividend X date and how much they're going to pay this month. And so this month, they're actually 42% annual distribution yield for this stock. This is wild. So this month it goes X on the 21st, which means that you have to have your money in by the 20th, which is, one business day beforehand. If the X dividend was the 20th, you'd have needed to have it in by the 17th. However, the X dividend date for USOI this month is the 21st. You have to have your money in by the 20th. Have it in by the 20th, you're going to get $2.84 per share for USOI. That's roughly $1,800 to me. Now, I would expect that on the 21st, after this goes X, so on the 20th, this stock's going to spike up pretty good. But then on the 21st, it's going to pull back, and it's going to pull back roughly $2.84 a share. So you're going to be net zero on that day, but you would expect that USOI would go up over time and you would be able to build some equity in the underlying in the process. Now 81's a little, it's medium price for this stock. I'd say 80 is a good price, 79 is a great price, and 84 where I have it is a terrible price. Now the other thing that happened to me this week is I tried to find it here. I got a couple dividends, one on Chevron, one on Marathon Petroleum. This was yesterday, another reason that contributed to the good day. I bought Phillips 66 to close. I sold another covered call on Phillips 66 that looks like on the 9th. But what I was trying to show was that I was actually assigned advanced auto parts. I had a put that I sold on that for $138, meaning that if it finished below $138, I would actually have the shares put to me, meaning that I have to buy them for $138 a share, even if it's lower. Now you can see yesterday it finished at $128 a share. So in theory, I'd be down $1,000 on this position. However, I did sell it for $205, meaning that my cost basis is really $135.95. So what that means is that as long as I sell covered calls in the $135 range, I should be all right with advanced auto parts. Now, why would I keep advanced auto parts and not just buy it back when I had the chance, buy that contract back? Well, the reason why is because this stock is actually a really nice value. And again, it's a bond proxy. It's exactly what I'm looking for. We're looking at a stock that's got a 15 price to earnings ratio with a forward PE of 11.98 and a dividend yield annually of 4.69. I get a payout next month of $150 on this. It has a net profit margin of 4.5, which is not great. It's not terrible. It has one. That's good news. And it does have some growth of 5.85% annually. If you look at it compared to the sector, which I admittedly, I don't fix a lot of cars, okay? But here's what I do know about advanced auto parts relative to AutoZone or O'Reilly's, is that I will go to the one that's just closest to the house. I don't care where my battery or my brake pads come from, as long as it's the one that's nearest to me. And it's even so bad that if an advanced auto part, if there was an O'Reilly's across the street and I have to go down the light and make a U-turn to get to it, I'll still go to the one on my side of the road. So these companies are all the same. And so to me, they're all the same. This one trades at a 15 PE, a forward multiple of 11, and it has a dividend yield of 4.69. When you look at O'Reilly's here, it's actually trading at $819 a share. Its price to earnings ratio is 24. Its forward PE is 22. It doesn't pay a dividend at all. If I look over here at AutoZone, we're talking about a stock that trades at $2,421 a share. It has a price to earnings ratio of 19.83 with a forward PE of 18.85. It doesn't pay a dividend at all. Again, their profit margins are a lot better on both O'Reilly's and AutoZone, and they do have a little bit better growth projected than both. But I don't know that it matters to a lot of us which one of these we go to. And Advanced Auto Parts has a much better dividend, and it trades at a lower price to earnings ratio, and deservedly so. It should actually trade cheaper than the other two. If you look over here at O'Reilly's and you look at their profit margin and their growth, you're going to see that it's also in line with AutoZone and much better than that of Advanced Auto Parts. Advanced Auto Parts has a little bit of a problem in that they bought out CarQuest, and CarQuest locations can be right next to advanced auto part locations, and so they tend to compete with one another. And again, if you live closer to a CarQuest, you're probably going to go that rather than drive another 2 miles to get to Advanced, and so they compete with themselves. But that being the case, I'm just looking at Advanced Auto Parts as a bond proxy, and I'm looking at the fact that I think that the market is actually going to go up the next couple of weeks. While I might be down about $800 on that new position right now, I think that by the 22nd, after that next FOMC meeting, I would expect that Advanced Auto Parts would be over $135 a share. At least that's what I'm gambling on. I'm also going to sell another covered call on it, but not until after the inflation print that comes out on the 14th of March. All right, so if you got anything out of this video, please like, subscribe, hit that little notification bell. Until then, have a great day. Bye. And now a word from my sponsor. Guys, have you ever gone on television as an expert on a certain topic, only to find out that you were a complete idiot? Well, you can now with my sponsor this week, which is beer. You're not going to believe it, but I think I know everything now. I think I know Kung Fu. So my sponsor this week is actually Reisdorf Kolsch, and you can see it's actually from Cologne, Germany, so you can legally call it a Kolsch. And I'm gonna have to give this sponsor 5 Kate Roonies out of 5. And another guy that likes to go on air using my sponsor is Jim Cramer. Let's see what he has to say about Silicon Valley Bank.
Especially if you like to imbibe. The ninth best performer year to date is SVB Financial. Don't yawn. This company's a merchant bank with a deposit base that Wall Street had been mistakenly concerned about. SVB is the old Silicon Valley Bank. Recently bought one of our favorite research firms, Moffett-Nathanson, and it's become less dependent upon private equity and venture capitalist offerings. Wait a second. Those dried up last year. They could come back. Yeah, some of them come back here with the stock directly affects an oversold position. Stock was the 4th worst performer in 2022. I think the fears were not justified, and it's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away. Being the banker to these immense pools of capital has always been a very good business. Stock's still cheap. Okay, Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is really, look, if there's one takeaway other than a plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly.